Let's bring on board our live guest. We've got with us Rajesh Kothari, is the CIO at AlfAccurate Advisors. Rajesh, good to have you on board. Thanks so much for joining in. While we haven't really taken the good news in our stride with the kind of recovery that we've seen overnight on Wall Street, what's your outlook as to where you see the markets headed at the current juncture, given that there has been a deluge of pretty unnerving headlines when it comes to the global banking system? Do you think, by and large, our markets have done okay in this circumstance?
Yeah, I think, if you look at on the economy front, of course, we are doing much better than, any other economy in the world. But, considering the recent correction in the market, I think it is providing a good entry point. In fact, there are 8 reasons why we should do top up, in my view. The first thing, if you look at our last peak, that was, I think, in September 2021. So it is almost 18 months of time correction. That is roughly, it means about 10 to 11% we get it cheaper. If you look at the price correction from 19,000 to 17,000, that gives you another 10%. So it means total discount is now 20%. During the same period, if you look at our earnings, they grew by 20%. It means total discount becomes 40%. If we look at from the valuation parameter, the price to earning ratio from 24 to 19 times. If we look at the price to book, we are at below 10 years average. If we look at the earnings yield, it is roughly about 5.6%. If we look at market cap to GDP, we are at 94%. I think the peak was about 112%. If we look at in last 18 months, the total economy growth, the GDP growth is 20%. And if you look at the Nifty is minus 9%. In whatever way you want to look at it, undoubtedly, the valuations are in your favor. And whenever the valuations are in your favor, that's a time where it's a good time for investors to do top up, to make an entry. And that's the reason why we are fairly positive market with 3 to 5 years.
Rajesh, let's just understand a little bit more when it comes to your sectoral perspective. Right now, if we're seeing some of the rate sensitives, it's not just that. Along with that, you've seen a few of the defensive sectors as well that have come under pressure, be it pharmaceuticals or, for instance, even FMCG. Do you believe that the sectoral rotation here is changing a bit?
I think, we need to be agile. That's what we always believe in. And we are never focused actually on one sector. We are fairly diversified portfolio, about 16 to 17 sectors, about 40 to 50 companies what we own. And I think there are opportunities within every sector. It is just not about one sector which looks good or one sector which looks terrible. Yes, but from macro perspective, what we like is capital goods. What we like is banking and finance, the automobile and auto ancillaries, and of course the consumer. These are the 4 sectors which we like it from the top-down perspective. Healthcare and IT sector, we have been underweight almost more than 12 months. We are of course watching that space because the valuations are becoming attractive there as well now. So I think it's going to be a more micro approach rather than macro approach. Of course, one needs to make sure that you buy the companies which are not going to be impacted by the global turmoil, or companies you should avoid over leverage balance sheets because interest rate cycle is still not in your favor. And you need to make sure that the companies what you buy they are at rightly positioned to gain market share. So that's what we always do in our portfolio, buying the leaders, buying the strong franchises, making sure they have the resilient balance sheet, under leveraged balance sheet, and making sure that they are rightly positioned to capitalize on the growth opportunity.
So if we could just narrow it down then, given that you're talking about the fact that, it is some of the large cap stocks that investors should look at. Let's take engineering, for example. It's been spoken about that India is likely to see a manufacturing renaissance. We have seen order book pick up, execution levels as well have improved. So where within this engineering theme are you looking at opportunity? Would you stick with just some of the heavyweights?
I think engineering is a very, very interesting space. I think there are in every sector, there are winners and losers. And if you look at the broad capex, then the capex growth is going to be, 9-10% kind of a compound. It's not going to be 20-30%. But then there are new growth drivers within capex. For example, companies which are positioned for data center, you will see 20-30% compounded growth over next 3, 4, 5 years. Because data center is going to become 5 times in 4.5 to 5 years. If you look at the companies which are positioned for the smart grid, the real solutions for the power grid, companies which have a product portfolio, companies which are into robotics, companies which are into automation. So it is that kind of a basket which is going to do extremely well. So if
Individual
you look at
theme.
our portfolio, we do not want
Right,
any
Rajesh, so
construction.
just if I could interject, apologies for that, but so which stocks would fit this bill? Would it be the likes of a Siemens, ABB, Cummins? Which are some of the names that you'd suggest?
Yeah, so these names, we already own in our portfolio, and I would not like to go stock specific, but if you look at our top holdings in portfolio, these are the companies what we own within the capex theme.
Okay. What about financials then? Would you be very just cherry picking within this space, looking at some of the large cap names? Do you think that, for instance, sticking with just the marquee names within the financial space would be the strategy, or is it a broad-based positive stance on financials?
Financials is always going to be more of a cherry picking, and therefore the marquee names is what we own in our portfolio. I think the loan book growth, if you look at the non-food credit growth, it remains 15% plus. And that is true from almost I think last 6 months, first time in last 12 years. That is very, very healthy sign. So loan book growth is going to be strong. The net interest margins are going to remain reasonably good, at least for next 2 to 3 quarters. It means you would have strong net interest income growth. The asset quality of most of the marquee names, what we are talking about, they were the best of the asset quality, and the credit cost is reducing. The provision coverage ratio is very high, and that means you would get also the strong earnings growth. Lastly, the valuations of banking sector, we are at a reasonable level. We are not in an overvaluation zone. So there is a lot of margin of safety in the entire banking and finance space as well.
Sure. What would be the approach when it comes to the mid caps, Rajesh? Do you believe that one really needs to be fairly stock specific here? Are there any particular themes within the broader markets that are of interest?
Yeah, so when we look at mid and small cap space, we make sure that we don't buy any small company by revenue or market size or market share or profit. The market cap might be mid or small because that's a regulated definition. And according to that definition, only 1 to 100 are considered as a large cap in India. So anything which comes below 100 becomes naturally mid and small cap. But if you look at it from the profit size perspective, there are about 650 companies in India which makes profit in excess of 100 crores, only 600 to 700 companies. And those are actually large companies. Market cap might be small because only 100 are allowed to be large cap. And that's basically what our universe. So just to put it our filters, like we look at profit size, we look at leadership, we look at balance sheet, we look at cash flows. And then of course, on top of it, we have a earnings growth as a very important criteria. And based on that, whether companies should be large in profit size, large in market share, it might be mid cap and small cap, possible. But if it fits our criteria, then that's how basically we identify the companies which are future wealth generation.
Okay, fair enough. Do you believe that, from the upcoming earnings season, maybe we could see some inflationary concerns perhaps hitting the consumption space? Are you worried about, the kind of global recession fears impacting IT, for instance? What is it that you're penciling in when it comes to earnings?
So when it comes to the cost side of earnings, the P&L side, if you look at the cost side, expense side, I think we are going to see tailwinds, because the most commodity prices have come down compared to where it was in 2Q and 3Q. Also, the semiconductor shortages have reduced. If you also look at the supply chain issues, that have reduced. If you look at the global freight index, which is a big part of the overall expense, that is also reduced. So the tailwind is going to be in your favor. The cost is going to be in your favor, particularly for the manufacturing companies, mostly. If you look at it from the global demand perspective, coming on the income side of P&L, if your company is positioned towards the US market as a customer, for example, for IT companies or for textile companies, it definitely is going to be a little bit adversely impacted. But if you are looking for companies who are benefiting from global China plus one relocation of supply chain, like chemical companies, capital goods companies, auto ancillary companies, they will be actually positively impacted because of the relocation of this supply chain. So I think what we need to do is that we need to do both sides, income side and expense side, and then you try to figure it out how it is positioned for next 2-3 years. And that's how, you basically take the right positioning in your portfolio.
Rajesh, good to have you on board. Thanks much for joining in and sharing with us your outlook on the markets.